Regulation is redefining the financial industry, impacting businesses and operations. Banks are expected to prevent, not just report, illicit transactions or face massive fines or personal liability. With financial crime compliance in the spotlight, we're enabling dialogue and debate. The message is clear. Transparency, innovation, and collaboration are needed to effectively and efficiently meet regulatory demands and enable new business opportunities. Join the discussion. Take your place in shaping the conversation in the world of compliance.
Good morning. It is a very great pleasure again to welcome you back to this, the third session today of the Compliance Forum. Putting this in context, this is really the session where we kind of take stock. We've had the regulators. We've dived deep into subjects ranging from the use of utilities for kind of AML KYC screening. We've dived deep into issues around securities transparency, and this is really a session where we get to take stock. We kind of cast our minds back 5 years and sort of see how the whole landscape has changed. We are hopefully going to look forward 5 years, and I mean I know it's a bit of an old saying that people trot out at a time like this when we're looking forward, but it's still a great quote. The old Yogi Berra, the baseball player, who spoke about how difficult it is to make predictions, especially when they're about the future. You may have also noticed that he was in the news recently. He unfortunately passed away, and he was wrong about one thing. He'd said you have to go to all of your friends' funerals, or nobody will come to yours, or they won't come to yours. And he was wrong about that one. A great many people came to his. We've got a great panel here. I'm not going to go in detail through all of their bios. You've got those, other than to say, sort of wide range of experience, both in the industry as well as on the regulatory side of things, and also that these are the guys who get the cool titles. If you read them very quickly, titles like Global Head of Financial Crime. I'm going to immediately kick off, and I guess we can start off on the far side of the room. Because John, let's just put this in some context. Let's kind of go back 5 years and to where we are today. Perhaps even 10 years. A huge focus on financial crime and regulatory.
Absolutely, I really think the landscape has certainly changed in the last 10 years. Really going back to, I think, the seminal event, which is 9/11, and in the U.S. that really changed the whole construct of AML compliance to a national security issue. So once that changed, the whole infrastructure and direction and importance of AML compliance in the U.S. Substantially changed. And you saw the impact of that through higher regulatory and supervisory expectations. You saw years later, of course, the passage of the USA Patriot Act in the U.S., which substantially increased the explicit and specific regulatory requirements. And then later you saw that impact in about 2004, and 10 years after that, for the last 10 years, you saw substantial enforcement actions. You saw DOJ and law enforcement take what the industry has called really the criminalization of AML compliance, and they've charged institutions criminally for deficient programs, and we've seen a lot of civil money penalties and deferred prosecution agreement. So I think that has substantially changed the landscape. I think the objective of the U.S. government and others are to increase the control structures among the financial sector, in particular the banking sector, and I think that those regulatory expectations have certainly increased and will continue to increase.
And just sticking with that, direction of travel. I mean, direction of travel is clear, I guess. Speed is less clear. We saw guys really putting their foot on the accelerator. Is that easing off a bit?
I think it is. I think as institutions broadly increase their controls, I think the risk to regulatory action or adverse regulatory action will decline. But I think there are some other added elements like the FATF mutual evaluation process that was adjusted in 2012, revised in 2012, which has two elements, the technical compliance element and then the outcomes or effectiveness measure. And it's that effectiveness measure, part component of FATF that has now just been recently implemented, that I think is going to put additional pressure on jurisdictions to support how they supervise, enforce, and utilize law enforcement in their AML regime. So I think that is going to certainly increase and continue the pressure.
Yeah, Guillermo, I'm going to stay on your side of the Atlantic as well. But I mean, what is your sense of once again direction of travel and perhaps pace of travel that you're seeing?
I think that we're living, I would say, a very particular moment in the AML arena because we are, I would say, over-compliant sometimes with the regulations. I think that the chaos that has been created for the fear of the banks against the regulatory and enforcement actions has been driving us to a state in which, rather than really complying with the regulatory requirements and making sure that we are having an effective process to manage risk, we're just trying to eliminate risk. And that's been leading, to some other topics and discussions that I know are happening about de-risking and, the way that we are dealing with risk. I think it's more than going to an effective manner. It's just moving to a phase of analysis paralysis, I would call it, right? In which compliance is getting, I would say, probably the backhaul drama feeling where, the line of business will need to touch base with compliance, not only to partner and to make sure that you are doing the right thing and you are having the controls in place, but also because, where in some cases, some institutions are just going to a zero tolerance of risk, right? And it's going to, I understand that the pressure from the enforcement actions have been a triggering event. And I understand that when you are under such pressure, there's a very small margin of action. But at some point, you turn around and it would be like thinking, if I get rid of all the PEPs, if I get rid of all the embassies and consulates, if I get rid of all the casinos, if I get rid of all the correspondent banking, my regulator is going to walk into my office and it's going to ask me the first questions, and the answers are going to be no, right?
Yeah.
You work in high-risk jurisdictions? No. Okay, so what are we expecting? That they will turn around saying, okay, there you go, here's your perfect score, thank you so much, we'll see you in 5 years? That's not going to happen, right? So, and at the end of the day, we're in a business in which we need to make sure that we are not jeopardizing or we are somehow getting the pipelines of the economy, which are basically, I would say, the correspondent banking efforts, right? How are we able to connect all those pipelines rather than blocking the pipelines to avoid the water going in, right? How can we filter the water properly, and how can we make sure that we're receiving the water that we need, the water that we want, but we're not just blocking the passage saying, this is the way to just eliminate risk.
Yeah, I'm going to come back to this whole question of de-risking because it's a big one. I know it's come up in some of the previous topics, but I just want to reflect two comments that came out in the opening session of this forum when we had the regulators up here, and we had the FATF and we had the Monetary Authority of Singapore, and they used pretty strong language. They were talking about egregious misconduct. Their words, not mine. They were talking about $325 billion in fines and kind of saying, we spanked the industry, they deserve it, and, they still need to be spanked. Are we on the same planet? You're saying we're over complying. They're saying egregious behavior. Where is the middle ground here?
Well, if there a middle ground, I'm not entirely sure, because I think in both there's some truth in it. When you just pick up what you said in terms of risk averse versus risk aware, where we originally said risk-based approach means there is some residual risk in theory, which then turned into zero tolerance, and I'd rather not take any risk. To me, though, however, it comes down to being able to take calculated risk, which would require, however, that you understand the risk in first place. And that comes down to systems and controls to a large extent. When you think about a lot of the banks that, when the $200+ billion fines that you mentioned, many of them have been to that scale that we have seen in the billions, because it was going on for a long time. It was not just one event, it was not just 10 events, it was going on for years. Quite often not even known well within the organization itself. Something the organization only learned as they uncovered and discovered. Banks are large, most of the global banks are large institutions, hundreds of thousands of employees, multiple countries, multiple different jurisdictions. So sometimes it may take a little while before you notice something. And that's the question of how well your control infrastructure is designed, operating and active, so that you can detect those things early and take corrective actions. Because by the end of the day, where you have people, there will be errors. Where you will have customers, there is a certain risk. I mean, there's only one way to eliminate all risk. We just stop doing business, close the door, and we go home. Therefore, there will be no business anymore, but there's also no need for any of us or any of us in the audience. And so this question is of how well do you understand the customers? And there's one thing when you bring on the customers, how well do you understand their business? How well can you monitor their business? And how well can you manage the conduct of the organization? Now, it's easy words, it's much harder in reality to put the right controls in place to not, here again, overburden the organization. Because if you put so many controls on it that the organization can't thrive and flourish, that's no good either. So finding that middle ground that you mentioned is the challenge.
Yeah, and I think, Jonathan, another aspect is, we're all sitting here, most of us are compliance practitioners, we're grappling with the problem as it is, but when you look at the difference between, like you say, egregious systemic conduct and individual failures, this is something we have to transport to the people outside the compliance department, the people doing the business. That's where you have, to a certain extent, you're going beyond awareness, you have lots of fear, and you're really trying to calm people down, and it's difficult to transport that message. So, it seems almost sometimes that, next to the compliance analyst and the compliance advisor, we might have the necessity for the new role of the compliance therapist, who is, really calming people down in that sense, because it's hard to, transport that message.
Yeah, I take that role. Compliance therapist sounds great.
And I was going to say, very good points, and I think in the beginning they talked about the risk-based approach, and I think fundamental to the risk-based approach is it's a very easy concept, higher risk, higher controls, but very difficult to implement, as Marcus talked about, as we talked about. And really how each individual institution uses those risk metrics to design their own control infrastructure for their particular risks of that institution is a challenging aspect of it. And also from the regulator's side, they go into each individual institution, try to understand their infrastructure, how they manage the risk, what is their risk framework, how do they comply, and evaluate. So on both sides of that equation, if you will, or both sides of that table, you have people making judgments around risks and how to implement those in the controlled environment of that particular institution and making judgments. And again, this is a risk context-driven, risk-based process or principles-based process. So that's where I think you see a lot of this tension, a lot of the disruption, if you will, in both sides trying to support this. This is a valid model to approach risk, and the regulators questioning that and trying to come to a common agreement. And there has been a lot of disruption around this, and certainly in the customer space with the de-risking.
Yeah, John, and I totally take your point about how difficult, how easy risk-based approaches sound in practice, sound in theory, how difficult in practice. But I guess the second question is just, to what extent do you think that the industry and regulators are on the same page on this? That, are they saying to you, we're comfortable with risk-based, but because risk-based is, about probabilities and must allow for some failure, are they actually going to allow you that failure?
I think so, but again, this whole construct is dependent upon folks who truly understand risk. And again, we're in a space here where there's a lot of senior financial crimes experts who have been in this space for a long time, very, very in-depth knowledge. But you have some people implementing it, right? As you go down in an organization, the expertise is not as high. Same with the regulatory side. So you get that tension of trying to get common understanding and implementation, which is certainly a challenge. But again, I think there is some flexibility in terms of understanding the risk. The challenge is obviously communicating to the supervisors your construct and being able to support it, which sometimes is challenging.
Marcus.
Yeah, let me just add to that, because I do think we are on the same page. We're just having a different interpretation of the same text. And we're working off the same book because we're all trying to do the same thing: protect the markets, prevent money laundering, protect customers. So we're all having the same intention. It's just a different interpretation. And the risk-based approach quite often comes down to a lot of subjectivity. The institution has one interpretation and one approach to it. A regulator may have a different interpretation, even though it is the same page that you're both on in principle.
Yeah.
But I think that that there's a danger there between the difference that we consider the risk-based approach, right? And we were making jokes yesterday that the risk-based approach, I said it's like a chicken nugget, right? Because we all know it's made of chicken, but we don't really know what part of the chicken is inside the nugget. No? And I think that the danger is that we are self-raising the bar. And since this approach is different by institution, I know that it should be different. You have a different footprint, you have a different client portfolio. But then when you start raising the bar, all the others start just trying to to get the same pace.
Match it or raise it above.
Right, and then the problem is that to what extent that becomes really effective, or to what extent it's just ticking the box, and now just a formal process. But when you really go into the weeds and you start asking about how do you really have your boots on the ground, and do you know really your portfolio, your jurisdictions, the answer is no, right? But you have 2,000 people doing tick the box processes, no, and at the end, would that be effective to keep the money laundering outside of an institution or the financial system? I think that's the hard stop that we might need to do at some point, and we need to rethink: is this the right strategy? Right? Is this more the biggest is my correspondent banking questionnaire, the better is going to be my correspondent banking program, right? Or should I just really have the adequate team, the adequate people that has the adequate knowledge of the products, of the business, of the regions, and then that people working together with the lines of business to making sure that you are protected?
Yeah. I mean, have we reached a point, though, where this kind of curve turns down again? John, you were kind of suggesting that less enforcement action over the next 5 years compared with the last 5. I mean, does the rest of the panel agree with that? That we're not likely to see those same?
I think there's a learning curve. It's a pretty long learning curve when you consider that. If you look at what the FATF published in 2007, at the time they pretty much said everything that needs to be said on the risk-based approach. But it's taken this long, and they have to reiterate the point now and really emphasize it. So it's an evolving thing. I mean, we've been dealing with this for now just over a quarter of a century. When you look at it historically, I guess these things take time. Lots of discussions like these have to be had, but there is an evolution, and hopefully the evolution will lead to something.
I'm not holding my breath to see any less fines anytime soon. So,
and tell us why. I mean, what's your thinking on that?
Keep in mind, it takes a lot of time. It takes a long time just picking up on this. A lot of the fines that you see now are not because of misconduct last month or last quarter. They go back to 2014, 13, 12, 10, 8, 9. Right. So you need to keep in mind that the environment that we run today will only really yield the value and show the robustness in the coming years. Because there's a kind of a 3-5 years delay between the actions you see now and the conduct that took place. So the conduct that we do today, I like to think, will lead to better outcomes and therefore hopefully to significantly less fines. But there's a time delay.
Yeah.
And there's really an organizational transformation that I know these institutions have gone through and others are going through to deal with the risk-based approach, the changes in the technology to a one customer view to an enterprise-wide processes. So again, I think we're clearly seeing transformation within organizations to try and orient to meet these expectations. And that takes time and will take time and will get sorted out in the future as well.
Yeah. So even if we haven't, potentially reached kind of peak fine for the industry, what is the question in terms of, I guess, kind of cost and headcount? Because the past few years have probably been good for guys in your positions in terms of, when this issue becomes an existential crisis for your employers, when capital is at risk, when the banking license is at risk, they throw money and headcount at that. Is your sense that this function keeps getting money and headcount for the next few years, or
it can't?
Yeah,
it can't, because banks just can't absorb all those costs. Because eventually you will need to transpose those or transfer those to the customers. So you would need to think about pricing, product pricing, make certain products completely unattractive.
Yeah.
If you would do true active-based costing and associate the cost of compliance down to the customer level, down to the product level, it would make many relationships unprofitable already today and many products unprofitable.
Yeah.
And I think that the challenge is 2 times bigger than probably 5 years ago when you were asking John. No? And I think that it's a totally more controlled environment, right? More regulated, more confined to this compliance world. But at the same time, we're facing that we need faster payments, right? Real-time payments, cheaper payments, a more globalized banking, I would say. Most of the institutions are trying to go international, no? And we have seen smaller players, buying different banks in other jurisdictions. So the world is going more globalized, and it's moving faster than, and in this environment where you need to keep all this compliance world, it's challenging to make sure that, that you're understanding where the technology is going, where these new disruptive technologies are going, right? And figuring out how can you keep the pace while also complying with let's say, with a conservative regulatory environment. No?
Yeah. Building on what Marcus said, as special as our area is, it's not completely immune to basic economic principles. And I think the factor that we're seeing now is, for the past year, for the first time, you have something that you could call political pushback, in the sense that you're seeing a conflict with other goals. World trade being threatened through de-risking. And so suddenly you have interests that need to be balanced, just like you have data security. And so it's not just a one-way street in terms of more regulation, but you see that there are other goals that need to be balanced with that, and that will maybe provide some sort of corrective.
Yeah. Yeah.
And also, just a quick point about the utilities, right? There are innovations coming up to try and deal with the costs, and so I think there's, again, innovation and a lot of initiatives around trying to deal with the cost structure issue.
A topic that's come up a couple of times already here, as well as in the previous sessions, is de-risking. So let's talk a bit about it, but the previous conversations were very much backward-looking. How bad is it? Can utilities help? Let's kind of cast our minds forward again. Think over the next 5 years, and I guess again, let's try and stick with this idea of inflection points. Sort of how close to peak de-risking are we, or does this process have a long way to go yet? Any thoughts?
You want to put anybody on the spot?
There we go. Never volunteer.
Let me try to dance around the topic, right? So, and circle in. De-risking is a question of, first of all, the definition of de-risking, right? Yeah. I think it comes down to extreme risk management, your risk appetite. I have no risk appetite for this, I don't want this. And that's then translated into de-risking. Eventually, though, however, our institutions de-risk. Those customers will need to go somewhere. The next institutions, they will de-risk. They will need to go somewhere. The next will, eventually, where do they go? Right, so when you think about correspondent banking, US dollar clearing, euro clearing, pound clearing, whatever it might be, they will need to go somewhere. They have financial needs, or their customers have financial needs. Global trade was mentioned before. So the question is, where do you go? Where do those customers go? And will there be an alternative clearing mechanism or a alternative payment infrastructure, like a little bit like a black market emerging, because you will need to do something. So de-risking is all great and good, but that will inevitably run into a dead-end street, because there will be no more to go if everyone de-risks.
Yeah.
So it's about the question, can you manage those risks and understand those risks better? And what is the regulator doing to work with other regulators in those jurisdictions? Or do we just say we cut off certain jurisdictions from the world trade?
And the risk is that, that probably, those players are going to still have the needs of clearing and settle payments, and they might probably go with, I would say, less complex or sophisticated institutions, right?
Yeah.
Or financial entities. And now we have seen even an increase of access to, let's say, other type of payments, right? And I think that at the end, I would say that it's only construed to client selection, right? It's about who you want to work with and where do you want to work with. And I think that the key part, I would say, for those banks that feel impacted by the de-risking, I would say make sure that you are showing them that you really know your risks, right? What I believe that the big institutions were tired is of the formal compliance. When you visit someone that has the perfect systems, that they have a ninja as a compliance officer, right? And they have all these beautiful things. And then when you ask them, okay, where do you do business? And they start, telling you in these high-risk jurisdictions, you ask them about inherent risk of that jurisdiction, and the answers are, well, we deal with everything here from our centralized location in X country, right? So if you don't really know what you're doing in certain very high-risk jurisdictions or with certain types of clients, if you cannot show us that you really understand that business, at the end of the day, all the formal things that you can show me and that you have thousands of people and you have all the systems available in the market, or, it all gets down to, show me that you really know what you're doing.
Yeah.
Not that you're just complying.
Well, I'm going to share a statistic with you guys that came out of also the earlier session when we were talking about big banks and small banks, and we did a little digivote. So here we're talking, a sample selection at Cybos. We're not talking, kind of bad players by definition. And the question was, has a correspondent turned away your business in the past year? How bad is the de-risking problem? Just under 80% said yes to that. So what we're really talking about is not just kind of bad actors being frozen out or kind of weak actors being frozen out. We're talking about quite legitimate players who just don't meet that profitability threshold on cost to serve. And I guess my question to you, for you guys, from your interaction with regulators, is this a problem that they get? Do they realize that they are kind of closing people out of the financial system? Perhaps I should start with you, Cecilia.
I think we're at a stage of recognition. We've recognized the problem. Regulators have recognized the problem, sometimes at a very high level. The paper we had just a couple of weeks ago from the Committee on Payments and Market Infrastructure shows that now we're getting to a more technical level where we're already talking about solutions, and so there's that part, but it's going to take a while, because if you recall the session you mentioned, there was the statistic, everybody voted, everybody had their fun, and then you asked for a specific example, and I didn't see a lot of hands go up. So when you get to the second stage of it, really getting down to the nitty-gritty, let's discuss, where's the problem, who's de-risking and why. Yeah. I think that's going to be a little bit more of a difficult discussion. So the path to getting the solution is going to take a while.
Yeah.
I personally think that you will see maybe a different structure and different approach than de-risking. Maybe one of the things that institutions need to think about is pricing risk. Because rather than just saying what volume do you do and how much are you going to bring to me, I think you will see more and more pricing of risk. So maybe a correspondent payment for Bank A will cost X, while for Bank B it may cost 3 times X because it's a perceived higher risk. We do this in credit, right? Your credit rating drives to an extent the conditions you get from us. We don't do this in other areas, and I think when you consider the amount of risk management you will need to do for certain higher risk, perceived higher risk parties, that somehow that needs to be reflected. Otherwise, people will walk away because it becomes an economic decision more than anything else.
Yeah, I think that's so true. I think really the risk management aspect and the pricing risk and the understanding of what is that return on that customer, which are our most strategic customers or regions or institutions, and that approach to making decision making about who in the customer base they're going to bank. Again, I think supervisors look at this, recognize that this is an issue. I think their primary focus, though, is really on whether that institution is managing their risk and doing that well and not taking unwarranted risk. So I think the primary focus from the supervisor's standpoint is that, although they do recognize and acknowledge this other aspect, this unintended consequence, if you will, that's impacting commerce and trade and things of that nature. And I guess in my view, until there's a significant tipping point in that space, I'm unsure what's going to happen there.
Yeah.
And it also comes to this loyalty, I would say, concept, right, in which the lines of business are looking to have broader and deeper relationships with the clients. So they are trying not just to get a single account, and they are trying to get more of the business from each client, because the more you have, the more you know them, right? And you grow together with those clients. And then when you have questions from the regulators, I mean, the involvement that you have already with those clients is bigger, and it's easier to defend your position of why you work with XYZ institution and how long you have been with them, rather than just having, let's say, one single step or one single portion of the business that probably, is not the most kosher one, I would call it, right? And then that's when the regulator will say, like, XYZ institution will never allow to happen, right?
Yeah. We could talk about de-risking all day. I'm not going to let us do that. Let's make up a new word, which I guess is, and it's probably going to be the wrong word, so you guys are going to correct me, but re-risking. The wrong word. But we're in a world where one is starting to see sanctions being lifted, one seeing movement on Iran, one seeing movement on Cuba. What does that start looking like over the next few years, and how does one firstly face a problem that kind of having dialed up sanctions, it's difficult to dial them back down and say to banks, come on back in, the water is fine. And let's start with you, John.
Sure. Clearly a very fluid area with Iran and the sanctions, and you saw in the newspaper this morning about the missile launch that Iran did, and there's questions about did that violate UN sanctions. So again, I think this space is very challenging and will be challenging. But fundamentally, with the agreement that the P+5 P5+1 agreed on going forward, that's going to go forward with the IAEA evaluating compliance, and as that moves forward, there'll be an implementation date between 6 and 12 months. As it's structured today, the UN and EU will remove their sanctions or hold those sanctions in abeyance. The US will keep their primary sanctions in effect, but repeal or take away their secondary sanctions, which affects third parties dealing with Iran. So again, this is going to be a lot of movement in this area. I know OFAC, the U.S. sanctions agency, stated just recently that prior to the implementation date, as that gets closer, they're going to send out and publish very detailed, or as detailed as they can, expectations around this space. But again, I think it's going to be another challenging area.
My view?
Marcus, yeah.
In the next 12 months, nothing's going to change.
Yeah.
Because just by the explanation he gave, the complexity that was involved in just that, that will leave many banks to say, my Iran policy ain't going to change until there's more clarity, because no one wants to take any unnecessary and additional risk. You will see here and there maybe an exception, but I do not believe that you will see a significant shift particularly on Iran for the next 12 plus months.
Yeah.
And I would say that for smaller institutions, the message is you need to have this is a very technical topic.
Yeah.
And you really need to have an expert on sanctions in each institution. I think that just thinking that the filters, right, or a third party, it's going to help you to do that. No, I mean, a third party vendor will definitely help you to put together your tools. But but as Mark is saying, I mean, it's a very technical stuff that I don't think that most of the U.S. banks were going to stay probably in the same stage right now.
I would offer a small counterpoint, though, because it's a unique situation for the one part because you have such a detailed and specific roadmap to the lifting of sanctions. Of course, there are lots of question marks still there, but rarely do you have over such a long period this kind of roadmap where we know mid-October there's going to be a publication of all sorts of regulations on the EU and the US side, and then we wait for Iran to keep up its part of the deal before in Q1 of 2016 we'll see those actually take effect. And I think it's clear, and I agree with Marcus, that within the banking industry, there is a very widespread hands-off approach which will be maintained for a while, but you do have to factor in the increasing pressure that will come from the corporate customer side. Corporations who are sometimes, still not as exposed as the financial industry with regard to regulations and enforcement, are still sometimes in a better position to take a more aggressive stance, and they will expect their banks to follow suit. Somebody's got to move the money. So you just have to factor that in. While I largely agree with Marcus, that'll be an interesting dynamic going forward.
Yeah. I mean, I guess if one of the issues that policymakers face is that, if sanctions are to be a tool, you don't just want the kind of punitive stick of sanctions. You also want to be able to say, investment and the like will flow as we ease them as a kind of incentive to good behavior. Is there a lot more that one needs to see, kind of policymakers, officials coming out with saying, actually, guys, we do want you going in there now, and this is a safe harbor?
Comes back to the clarity, right? Because as long as it's not exactly crisp clear what you can and cannot do, banks will be cautious, because no one will then be found out 12 months down the road, 18 months down the road, where you shouldn't have done this transaction. Right. And so that's one. The other one will be, if you go in, then there will be an enormous control regime around, with every single transaction being reviewed, signed off, assessed 10 times by multiple experts, maybe even get external advice. So it's not kind of you lift the sanction and off we go. Because don't forget, it's not just the banks, right? I worked for an insurance company before. Insurance struggled with this the same way, because the sanctions also apply to insurance. So you can't ship in and out goods without being insured. You don't get insurance easily. You can't move the funds easily. So yeah, corporates will put up the pressure because they want to do business, rightly so. But that will require a very clear framework saying, this is what you can do, this is what you can't do. And as long as it's clear what we can do, I think bank will be willing and supportive to do this. But it needs to be very, very clear what you can, and not have massively complex regime. Yeah, you can do this, but then only in those circumstances, only in the Monday afternoon, but not if it's the 13th of the month.
And the pricing, right? And the cost, again, is going to be different.
Right. I think we're seeing a little bit of your point in the Cuban area, and recently heard that the U.S. government is concerned because there isn't more business activity. Of course, it's a different case than Iran, and so that's again the clarity point is well taken, and I think until that is even sorted out in the Cuban sanctions situation, there's again this variability, there's this risk aversion atmosphere, so institutions are naturally cautious in this area.
You gave us a great summary on sort of where we are, state of play on the Iran sanctions. Could I pick on you to to just give a quick overview of where we are in Cuba as well and what the.
That too, the U.S. has dialed back its sanctions and removed those. It's created a diplomatic embassy in Cuba. It's further extended the initial engagement was really just to allow some initial engagement around business, and now they've opened it up for travel and commercial enterprises. So the pendulum is clearly swinging toward access and much more commercial activity.
Staying with sanctions, and let's kind of throw this forward again. We've been talking about sanctions against states, which I guess are a relatively simple matter compared with the more complex kind of terror financing, seeing a lot of talk again in the session with the regulators. The FATF spoke at some length about Islamic State, ISIS, ISIL, whichever you want to call it, and the challenges of cutting off finance there. I mean, do you guys foresee that over the next 5 years that's going to be, a significantly greater focus, both sanctions on individuals, home country nationals joining these groups, as well as trying to cut off the kind of financial flows via oil, etc.?
I would expect more of these, what I would consider targeted sanctions, rather than a ban on a country, that you have more targeted sanctions. Ukraine was a good example where it was not all of Russia, it was not all of the Ukraine business, it was very targeted to very specific areas. And we see the same with ISIS. Now that sounds better, but indeed, as you said, that makes it way more complicated for banks, way more complicated. If you just think about the Ukraine sanctions, there's no black and white answer. You need to look at every single transaction if you want to be absolutely certain that you stay on the right side of the line. So while these targeted sanctions make more sense to target individuals and specifics, but there's so many, if they hide behind child companies, complex structures, banks are expected to understand those structures. So just looking at the payment, saying, oh, the name is not there, right, good, we move on, is not good enough. That's not good enough anymore. You need to look behind the payment. You need to understand the relationships. Well, it's kind of okay with your customer, because you should have that information available. It's much harder with third parties that you do not have information on. So targeted, easier because you have clear areas to focus on, much harder to implement, however, in operational terms.
Yeah, I think from a government policy standpoint, it's a much more scalpel approach versus a sledgehammer, and I think they like that, and I think that's going to continue. But again, operationalizing that is significantly difficult. Again, the entities and the affiliates, and what is the percentage ownership, and
beneficial ownership,
and
exactly.
Clarity around who does own it. I mean, all of those aspects has caused significant consternation in the industry, especially in the sanctions space, trying to grapple with these newer approaches to sanctions.
Yeah.
And you have to keep in mind sanctions, or the increasing popularity of sanctions as a foreign policy instrument, where we've seen the results of sending troops as a foreign policy instrument, and sanctions are not a full alternative, but in terms of what you can do, are increasingly popular. And some have spoken of financial warfare in this context. And going ahead 5 years, you may even see a development where this foreign policy instrument is increasingly used to target more and more human rights violations, and so you may actually be extending the scope. And as the colleagues have said, while it's politically popular to use the scalpel, to use the targeted sanctions, what's good on the policy side is a headache on the implementation side.
Yeah, and how is the industry responding? I mean, is one seeing? I mean, clearly people want to comply, but is the easy response, again, to just back to our earlier conversation on de-risking, kind of anything that even sounds like Ukraine, anything that sounds like, large parts of the Middle East,
Yeah, well, it's not that simple anymore, right? If you look at Ukraine, the banks not necessarily operating in that part where the sanctions apply. The banks that your correspondent banks, they would be somewhere else. So de-risking not necessarily coming in. Yes, you may say certain corporations in that area you would not take on, but it's not many banks, particularly global banks, who would have those corporations in the first place. It's more payments from and to these areas, from and to those parties. And that can happen to any bank at any point in time because you don't know where your customer is going to send the money to or where he or she is going to receive the money from.
Yeah.
It makes more difficult the correspondent banking relationships, no? In terms of
way more.
underlying financial institutions and where your payments are going to end up. It's a very tough situation.
I mean,
I was just going to say, any of the global institutions, I think, have just put tremendous resources trying to sort this out. Because if you're in the international payments, if you have corporate customers that are dealing in Eastern Europe and Russia, you've got to sort through this, and it's just hard, hard legwork trying to sort through this and doing the best you can.
And the vast majority of the payments are absolutely perfectly fine.
Right.
Yeah.
But to find that one or two that's not fine, you still need to look at all the others.
And Jonathan, you may have a very personal experience regarding this the next couple of days, because just last week OFAC put a family in Honduras on the list that has exactly your last name.
Right. So if my credit card doesn't work,
some of the payments will take a little bit longer now.
Exactly.
Then
We should keep in touch.
if that holiday cottage calls you, where's my payment? I've not received it, so we'll be stuck somewhere.
And good luck entering the US as well.
So I'm on a flight blacklist. I'm on a. Well, there we go. Who knew that coming to Sibos was that dangerous? I'm going to see if there are any questions and comments from the floor. And please bear in mind that I'm staring into the light. And
we have microphones at the back, I think, to the left.
Okay, so do we have mics and.
There's a question over there on the right.
Okay, thank you. So question over here, please.
Jonathan, thank you for that. Henry Bellani with Acuity. John, I guess it was useful for you to raise the issue about Iran and Cuba and the different lifting of the sanctions and so on. One of the research items that we've been looking at really was understanding the delta between what OFAC has been lifting in terms of the entities versus what the EU has, right? So if you think about the banks, for example, there is actually more banks that are being lifted, Iranian banks that is, that are being lifted from as a result of this agreement than the US OFAC is doing. And so there's a delta, right? So if I'm a European correspondent bank and I have a relationship with a US correspondent bank, and if I find that as a European correspondent bank, I'm actually dealing with a sanctioned entity in Iran from a US perspective, what do? What does the US correspondent bank do when they recognize that there is a potential sanction violation, sanction entity that the EU correspondent bank has a relationship with? All of you stated that nothing's going to happen over the next year or so. But the reality on the ground is that you're going to have European corporations coming along and saying that we do need to move this. There's opportunity in Iran. We want to invest in Iran. What do the European and the US correspondent banks do?
Well, there's an interesting point that you bring up, the differences in the various lists, right? From UN to US to EU to local other lists. Most of the institutions, most of the global international institutions have taken a very simplistic approach to take 3, 4, 5 off the list and apply them globally, period. So even if there's a difference, your risk appetite is you apply this globally. Because you do not want to run this risk. Yes, a euro payment today, you let it through. Tomorrow, that same customer is doing a US dollar payment and you're caught. So you apply a very conservative approach. You don't even go down to that nitty-gritty detail. Well, if the customer is actually not involving a US entity, there's no US person involved, there's no US dollar involved, there's none of my US business involved, there's none of the servers that I have, there's maybe hosted located in the US involved in that transaction, I may be able to do this. Way too complicated. You basically say, look, either you agree, you policymakers, or we just apply all of these major lists and apply them right across all businesses. I speak for at least most of the international institutions that I know, and you nod your head as well. I guess it's the experience you have as well.
Which is really bad news for Jonathan.
It is, yeah.
There we go. I mean, any other comments on this or
No.
on that dilemma? Further questions and comments, please. Any other hands?
Is everything that clear?
Or people are desperate for coffee are the one. But you're not leaving early anyway, because he has plenty of questions, I know.
Well, yeah, I can keep going. So, okay, so that, no other questions. Thank you for that one. It was a very interesting one. Let's kind of now really do some crystal ball gazing. We've been talking about increasing use of financial sanctions. Cecilia, you were talking about the fact that it's an increasingly popular tool. And I just wonder if, forget 5 years, maybe even let's look ahead 10 years. What are the unintended consequences of us saying, when I say us, I mean the kind of, the major Western powers saying we can police the world primarily through its access to the US dollar, and we have a tool that we can use, and we're going to keep using it. Where does that go?
I would say there are other currencies too.
Right.
So I guess that's something that we will need to see how this plays out. But obviously, there's more than the US dollar in global trade. Still, by far, the most dominant currency being used in international trade. There's no doubt about it. We all see that in our international payment traffic, in our trade business. There's no doubt about it. It's a dominant currency. I don't have the statistics, unfortunately, for the last 10 years, how it maybe has shifted from what it was 2005 to what it is in 2015. It would have been interesting to see maybe the global percentage if there was any shift. But you have other currencies and other large players in the market. China importing, exporting a lot. Obviously, the renminbi becoming very dominant. You see a lot of renminbi business coming up in many countries. Many trade corridors that open up, and they move away from US dollar only. Now, is that the answer? I don't know, but my crystal ball is a bit murky, but I wouldn't surprise me if you maybe see a shift. Would that mean the US dollar would drop in importance? Maybe not, but maybe in the overall balance, you will see a shift.
And building on that, even if the shift does occur, suddenly you have other countries with dominant currencies with perhaps other foreign policy goals that will then, have extra-territorial impact.
Yeah.
So there's that as well.
Yeah.
Yep.
And the new technologies are going to be key, right? I think that all these new services might probably be changing the playing field on all these payments era, and that might probably have an impact, I don't know, in 5 or so years in that change to another currency, probably.
That could well be. Yes, maybe play multiple things that happen is currencies, maybe more technology requirements, more transparency. One of the things that I'm absolutely certain is the demand for transparency or increased transparency is not going to go away anytime soon.
Right.
That's going to be the topic for a longer time to come. And how can you establish more transparency rather than less transparency?
Yeah.
More structured data, more insights into your customer, more underlying information carried with transactions, that banks and institutions who clear those payments and transactions have more insights when they do so. Mm-hmm. I'm absolutely certain that this is not going to go away. So if you ask me what's in 5 years, that will be the same topic as how can we increase the transparency. And I'm pretty sure from now till then, we will see measures that either from the industry moves or regulators putting up the pressure of increasing transparency even further.
I just want to stick with this question of the dollar's preeminence, and I know that a lot of it is going to be driven by trade flows, etc. But anecdotally, I've been spending a lot of time in Africa lately, and one is hearing about increasing desire to be pricing in RMB, increasing desire to have RMB accounts. And I wonder whether anecdotally you could share any of that, whether something that you guys are seeing. And what the consequences are.
You just have to go down to the salespeople and ask how the trade flows are changing, how many accounts and how many requests they get for renminbi accounts, which is significant, particularly the corridor Africa, Hong Kong, Africa, China. There's a significant demand. So I wouldn't surprise me if you see a significant shift, particularly for certain countries. And now that comes back to de-risking. Mm-hmm. Is the de-risking maybe a shifting from one currency into another currency?
Yeah.
Right, to align more with foreign policy goals.
Yeah. I want to talk to us a little bit about regulatory fragmentation as well. I mean, clearly a lot of effort over the past few years, G8, G20, FATF, all of the like, to try and get some harmonization going. What is the experience at the coalface as to whether we're seeing that harmonization, or in fact, are we still seeing regulatory fragmentation and as a result a real risk of a kind of fragmented industry?
I'd say there's two levels to it. If you look at the actual laws and regulations on the books, I would argue that we've got less fragmentation in that sense because, you know, the FATF has done the work that it's done. Everybody's pretty much aligned with that approach. But that only gets us so far because it doesn't end with a strict legal analysis anymore. You know, everybody knows there's a difference between what it says on the books and the conversation you have with your regulator. And that delta is then a difference of the you know, actual practice that different regulators across the world will apply. And that's where you can still have the fragmentation.
I agree. I think that, you know, that the level is pretty much similar right now, with the exception of a few countries that are still in the blacklist or the negative list, right? But I would say that the enforcement, right, and the examination and the supervision, that's the tricky part. Because at the end of the day, we can all have these beautifully written laws saying that, you know, that everything is perfect. But then when you turn around, there are still some players that I believe, mostly outside of, I would say, the non-bank financial institutions, they are still playing probably on a different level than the banks.
Yeah, and if you put a speed sign up in a street that was 30 miles and is now 20 miles, and people are used to drive 30 miles in that street, unless you put a few speed cameras up there, there will not be much change of behavior for the maturity.
Right.
There will always be some who will obey and some will follow, but if you're used to driving 30 miles an hour, maybe you've not even noticed that sign that has changed. So yeah, enforcement is a big part of it. Now, is this an invitation for any regulator in the room to have more enforcement? Not necessarily, but I think to have more stronger, if this is a rule and if this is a regulation, have a level playing field. Because if you have some markets being really clear about the enforcement, other markets not as much, there is a risk of regulatory arbitrage.
Mm-hmm. Yeah.
Right.
You mentioned, sorry.
No, go ahead.
You mentioned the risk of regulatory arbitrage, and I guess an elephant in the room here is, and I'm going to ask this question very carefully because you guys don't want to make headlines. I don't want to irritate you so much that I get put on your blacklists. So we've got a kind of mutually assured destruction here. But clearly, when one hears what the chief executives of large institutions are saying, there is certainly a perception that that regulation is being applied in a nationalist way that is favouring certain industries. I mean, there have certainly been complaints from the European side of things, and here I'm really talking the kind of mainly investment banking side of the house, but there is certainly a perception in Europe that they are being unfairly penalised. And I just wonder if you guys have got any sense as to whether, apart from the actual harmonisation of regulation, whether, you know, regulators themselves are playing with a straight bat and applying the law equally, or whether so as I say, you can answer this carefully so that you don't get into trouble. But is there anything to that perception that perhaps there's a nationalist enforcement?
Well, let's break the ice here. I'm not sure how big the elephant is, but the room's large enough for a large elephant. I'm not sure if it's true in the financial crime space, but let's take a step back. In regulatory terms in general, what you have seen after the financial crisis 2007, 2008, you have seen certain movements to encourage and benefit national business versus international business in a number of markets without calling any one particular out. But you have seen that certain regulations maybe have fostered such a behavior to protect the national interest a little bit more over international interest. That's something I think you generally between 7, 8 and now you can see. Is that true for financial crime? I don't necessarily think it's true for the area that we talk about generally.
And we have seen a lot of regulations, you know, related to capital flight, for example, and tax, right? And tax topics that at some point for us, the international firms, I would say they are still important because as tax evasion is, you know, it's one of the predicate offenses in most jurisdictions. It becomes also a very technical matter while advising the business if they can do or if they can offer certain products, if they can offer certain type of businesses in certain jurisdictions, right? And we have seen that you need to comply with the local regulations while not, let's say, breaching the local regulations by allowing some services, but at the same time, you are a U.S. institution, let's say, and you might need now to make sure that your client is not using you to avoid the regulations that have been implemented in that country.
Yeah.
Although you need to specify if you mean tax avoidance or tax planning, right?
Well, right, that's the difference. You're absolutely right, yeah.
A lot of these sessions I've been closing off by getting people to make a little forecast, sort of top idea of what's going to happen in the next 5 years. I mean, frankly, we've been speaking about that for almost this entire session. So there's a bit less utility to that. But what I'm quite keen to get is, I guess, a bit more of a personal view as to what is going to be your focus or your personal sort of priority over the next 5 years, and perhaps we can start.
Sure. I think just with the transformation of the industry in the financial space, I mean, I think the primary focus and what we're going to see in 5 and 10 years, excuse me, is a much more robust integration of financial crimes in the risk management framework of the institution. Mm-hmm. I really think that we're seeing some of that now, some institutions more than others, but that truly to have sanctions and AML fully integrated into the risk management DNA of an organization that provides valuable information to the chief credit officer, the CEO, and the board to look at AML risks and sanctions risks, financial crimes, across evenly on equal footing across the organization, I think ultimately is a critical change factor. And I think once that is achieved across many organizations or the industry, I would presume that any of the culture of compliance issue, governance issues would be resolved at that point. Mm-hmm. So you really have a fully integrated risk management infrastructure within an organization looking at all the risks.
Yeah. Marcus?
For me personally, going on vacation. That would be a nice change. But
for 5 years?
Yeah, well, that would be a very nice change. But no, I think you asked in terms of the business. My personal view is technology, right? I think we need to get way smarter with technology. But that's a double-edged sword, particularly in the financial crime space. The more advanced you want to go, the more progressive, the more sophisticated you want to go, you need to take the regulators along with you. Because it's no good if you want to do the most sophisticated thing in the world, be more efficient and much more effective, if people don't understand, and people in this case regulators don't understand what you're doing, and force you back to the good old rules base, and this is what we do, which creates a lot of work, which is very little value add. I think we need to do way more in that space, but it's a learning journey for the industry, but also for the regulators to work together on it, because both need to understand what the capabilities are and the opportunities.
Yeah. Guillermo?
I think I will also go with sophistication. I think that it needs to happen in both stages, in compliance and in the line of business. I think that it's demanding to have the right people on the compliance teams. Most of the institutions are growing a lot, and not in all the cases are choosing, I would say, the right people. It's just, just filling out the open spots. And I think that the other one would be that the market is somehow settling down.
Yeah.
Really hard to add to that, but I think that the financial industry, I hope, continues to engage and challenge both the regulators and the policymakers on finding this balance between financial crime prevention on the one hand, but data privacy and also economic considerations like global trade and development, and finding that balance. And personally, I would really like to be part of that discussion.
Excellent. Well, I think this has been an incredibly wide-ranging panel. We've gone from kind of sanction. We've covered a huge amount of ground. I'd like to ask you all to please thank the panelists for their great insights. Thank you.